Today, we have an exciting topic to discuss: how to use the 2023 recession to build wealth. Now you might be thinking, wait a minute, why would I want to invest during a recession? Well, that's precisely what we're here to explore. So let's take a quick overview of the 2023 economy. We're facing some significant challenges: high inflation, the Federal Reserve raising interest rates, and a suffering stock market. It's a combination that can make even the most seasoned investors cautious. But here's the fascinating part. Amidst this challenging period, there are successful investors who are not only weathering the storm but also strategically capitalizing on the market. One name that immediately comes to mind is the Oracle of Omaha himself, Warren Buffett. In 2022, Buffett made some significant investment moves that caught the attention of the financial world. While others were selling, he was buying. And this is not just the first time Buffett has demonstrated this strategy. Throughout his long and illustrious career, he has repeatedly capitalized on economic downturns to amass enormous wealth. Now, let's take a trip down memory lane. During the financial crisis of 2008, while panic was gripping the markets, Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." He backed up those words by investing billions of dollars into struggling companies and emerging even stronger as a result. This is a man who understands how to navigate through rough waters and come out on top. But here's the thing, Buffett's approach is not an isolated incident. Throughout history, we've seen some super investors make strategic moves during economic crises. They bought during the crash of 2020, during the financial crisis of 2008, and even during the dot-com bubble burst in 2001. So, what's their secret? How have they managed to turn economic weakness into an opportunity for wealth creation? Well, in this video, we're going to uncover 3 fundamental rules that have guided these successful investors. And luckily for us, a close friend of Warren Buffett, the renowned investor and author Mohnish Pabrai, has taken the time to explain these rules. With his insights, we'll navigate through this challenging economic period and position ourselves to build wealth. Rule number 1. Identify companies with a durable competitive advantage. First things first, what exactly is a durable competitive advantage or moat? Well, think of it as a protective barrier that sets a company apart from its competitors. It's like having a secret weapon that keeps others at bay and allows the company to maintain its market dominance. In the investing world, this is something we definitely want to look for. So why is finding businesses with intrinsic characteristics that set them apart so important? Well, these characteristics give companies a unique edge that others find difficult to replicate. It could be a groundbreaking technology, a powerful brand, exclusive distribution rights, or even a vast network effect. These traits create barriers that make it challenging for competitors to catch up or surpass the company's success. Let's look at some real-life examples of companies with strong moats. Take a giant like Google, for instance. Their dominant search engine and vast amounts of user data give them an unparalleled advantage. They've built complex algorithms and infrastructure that are not easily replicated. This moat helps Google maintain its market share even in the face of economic challenges. Another company with a formidable moat is Amazon. Their vast logistics network, efficient operations, and customer loyalty make it incredibly difficult for competitors to match their scale. They're constantly expanding their offerings and using their data-driven insights to stay ahead. These factors have propelled Amazon's growth and made it a force to be reckoned with. It's important to note that companies with strong moats are more likely to withstand economic challenges. Think of Coca-Cola, a brand that has been around for over a century. Despite economic downturns, people still reach for their refreshing beverages. The strong brand recognition and customer loyalty act as a moat, helping Coca-Cola maintain its market dominance. Another example is Microsoft, a company that has been able to adapt and evolve in the ever-changing technology landscape. Their robust product suite, including Windows and Office, has solidified their position as a leader. During economic downturns, businesses and individuals still rely on Microsoft software, providing them with a resilient moat. During tough economic times, people tighten their belts and cut back on spending. That's why it's important to invest in businesses with desirable products or services that people won't easily switch from. Regardless of the economic climate, think of everyday essentials like toothpaste or toilet paper. People need them no matter what. Companies that provide such products have a moat protecting them from economic downturns. Don't forget to subscribe and hit the notification bell to stay updated with our latest content. Enjoying this video? give it a thumbs up and share it with your loved ones. Now, let's jump right back in. Rule number 2, exercise patience and think long term. Patience is key in value investing because it allows us to take a long-term view and avoid being swayed by short-term market fluctuations. As the saying goes, Rome wasn't built in a day, and the same applies to wealth creation. By patiently holding on to our investments and thinking long-term, we position ourselves for greater potential returns. One advantage we have as long-term investors is the luxury of time. While short-term focused investors may panic or react impulsively to market volatility, we can take a step back and make more informed decisions. This longer time horizon allows us to ride out temporary downturns and focus on the underlying value of our investments. A very good example of the power of thinking long-term is none other than Jeff Bezos and Amazon. Bezos famously prioritized long-term growth and customer satisfaction over short-term profitability. This approach allowed Amazon to build a massive e-commerce empire and transform various industries. By thinking ahead and investing for the long haul, Bezos and Amazon reaped incredible rewards. Long-term value investing also enables us to seize opportunities during market downturns. When the economy is struggling, great companies often face temporary setbacks, resulting in discounted stock prices. By exercising patience and thinking long-term, we can buy these exceptional businesses at favorable prices and wait for the recovery. It's like buying quality merchandise on sale. In contrast, many active fund managers have a short-term mindset. They often succumb to the pressure of beating the market on a quarterly or yearly basis, leading to frequent buying and selling. However, research consistently shows that the long-term success of index funds often outshines the active fund manager's short-term strategies. Holding businesses with proven moats for an extended period can be highly beneficial. Remember the first rule? Identifying companies with a durable competitive advantage? Well, when we hold on to these companies for the long term, we allow their moats to work their magic. Over time, their intrinsic characteristics help them maintain their market dominance, driving long-term growth and potentially delivering substantial returns. Rule number 3, assess valuation but consider high-quality businesses. When it comes to investing, we often hear the mantra, buy low, sell high. And while that's important, we shouldn't overlook the significance of assessing valuation while considering high-quality businesses. Valuation helps us determine the fair price to pay for a stock, ensuring that we're not overpaying for our investments. But at the same time, we don't want to miss out on high-quality businesses just because they might initially appear to be priced higher. One investor who exemplifies this approach is none other than Warren Buffett. Buffett focuses on buying great businesses at a fair price rather than solely seeking bargain prices. He understands that quality businesses can generate substantial returns over the long term, even if initially bought at a higher valuation. This is a valuable lesson for us as we navigate the 2023 recession. It's important to remember that high-quality businesses possess certain characteristics that set them apart. These businesses often have durable competitive advantages, strong management teams, and a track record of consistent performance. They have the ability to weather economic downturns and emerge stronger. By considering the quality of a business, we can better gauge its ability to generate sustainable growth and create long-term value for shareholders. Let's take a look at a couple of successful investments made by Warren Buffett to highlight the power of considering high-quality businesses. One notable example is Coca-Cola. Buffett recognized the enduring strength of Coca-Cola's brand, its global reach, and its ability to generate consistent cash flows despite concerns about its valuation at the time. Buffett saw the long-term potential and made a wise investment decision. Another example is Buffett's investment in Apple. Despite skepticism surrounding the company's valuation, Buffett recognized the quality of Apple's products, its loyal customer base, and its strong ecosystem. He understood that even if the valuation seemed high at first, the long-term growth potential of Apple's business justified the investment. As we've seen, Apple has delivered impressive returns over time. So as we navigate the 2023 recession, let's not solely focus on finding the cheapest stocks. Instead, let's assess valuation, but also consider high-quality businesses. Warren Buffett's approach of buying great businesses at a fair price has proven successful time and again. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.